Okay, so in chapter 11, we are going to discuss the concepts of standard cost and variances. This is chapter 11. Okay, so for objective number 1, we're going to discuss and explain how and why standard costs are developed. Okay, so the concept of standard cost in terms of pure definition, in this particular chapter, it's still based on the concept of budgeting, but for this chapter, it's going to be looking at a budget for a single unit of a product. And so you'll see in the upcoming slides, we'll look at our product costs for direct materials, direct labor, and overhead. And typically, we're going to use these standard costs are simply benchmarks where we're trying to improve performance, we're trying to save cost, we're trying to evaluate the overall process of the company. Now, the basic types of standards when you're creating these to judge performance, there's what they call ideal standards, which is if everything is perfect. These type of standards are no good because they do not allow for any inefficiencies. So in other words, you assume everybody comes in on time, nobody is sick, there's never any machine breakdowns. This is not really what you want to do. Typically, what you want to set up is what they call practical or attainable standards, which allow for normal amounts of waste, normal amounts of inefficiencies. Again, this could be downtime from machine equipment failures. It could be personnel changes, you're training new people. So it's the practical standards are what you want to try to set up as your benchmarks. So as you're trying to create these benchmarks and standards, typically what you rely on is past data. What happened last year, what happened over the past few years. You look at how you use materials, how you used your labor supply. You also look at what is currently happening in the workforce in terms of the current cost. And then you also look at what you think is going to be happening in the future. And then you try to incorporate all these into one benchmark to compare your actual performance. So what we're going to be doing is when we set up these standards, we're going to go with the 3 product costs we've been looking at all semester. So remember we had product costs are direct materials. We also had the product cost called direct labor. And then the third one is called your manufacturing overhead. We're going to have not only standard costs, but eventually we're going to show you how to calculate the variances for all of these costs to evaluate your efficiencies in the company. So to calculate the standard cost for direct materials, what you do is you take what they call the standard quantity of direct materials. Again, this is some sort of budgeted number that will be given in a problem. You'll take this and you're going to multiply this by a standard price. That's typically a price that you set that you would pay for raw materials. And then when you multiply these, that's going to be your benchmark. That's going to be your standard cost of materials. Regarding labor, it's the same idea. You look at the standard labor hours allowed. Again, this is going to be some sort of benchmark number. You multiply this by some sort of standard average labor rate, and then what's going to happen there is that's going to give you the standard cost of direct labor. So then when you get to the third product cost on manufacturing overhead, typically there's going to be 2 parts. One part is where you look at your variable types of overhead cost, and then the other part is where we're going to look at the fixed types of overhead cost. So some of these calculations may seem like review, like for example, if you were to take the total estimated variable overhead, divide that by some sort of allocation base, that's going to give you a manufacturing overhead rate for your variable cost. You can then also get the standard cost by taking some sort of standard quantity allowed multiplied by this variable rate. So once you get basically part 1, you're going to use this in this calculation, and then that's going to give you this standard rate for your variable overhead. When you're looking at your fixed overhead, we'll look at your total budgeted fixed, again divide by some sort of base. That's going to be your fixed overhead rate. And again, notice this is going to be used in the second calculation to get the overall standard fixed cost for overhead. Again, you take some sort of standard quantity, again that's going to be the benchmark, times that fixed overhead rate. That's going to give you your standard fixed overhead cost, or I'm sorry, standard fixed manufacturing overhead per unit number. So if you look at this particular exhibit, they're showing you the standard cost to make one case. So just to kind of simplify this, you'll note we've got our product cost. Here's your direct material, here's your direct labor, and then they split the third product cost overhead between variable and fixed. And notice they've given you standard quantities. Again, these are your benchmarks. The standard prices, again, these are your standards. You simply multiply each of these, and then what you get over here in this column is you get the standard cost for all your direct materials per case. You would add them up, and in this case, your total standard cost, including all of your 3 product costs, would be $12. Okay, so usually once you have actually set up your standards and you start to evaluate performance, you always have to kind of rethink and update standards every year for, various reasons. Typically, companies lots of times they'll either re-engineer their product or just with advances in technology that's going to save time and money. You may have to change your benchmarks and your standards. So, you always look at updating standards. You always have to look at, for example, there could be government regulation, there could be some new rules and procedures that require you to do your production process differently or your service project differently. So just to kind of make note that, once you've started to create standards and use those to evaluate performance, you always have to kind of maintain and keep looking at these and updating these as throughout the years to maintain relevance and make sure that you're current with what's happening in your company. And so even though we already covered the concept of flexible budgets in the previous chapter, you actually have already used the concept of standards when we looked at cost behavior. So when they talk about in this chapter, this is Exhibit 11-2, where they're talking about creating a flexible budget by using these standards. Well, if you look at these three product costs where you have direct materials, direct labor, and your variable overhead, all these numbers represent cost per case. And of course, these are all variable cost. So it really is relating to cost behavior. And so, but these are now incorporated now in this chapter where they're not only incorporating the concept of cost behavior, but they're mixing that in with the concept of standards as well. And you use these basically to create your flexible budget. This is essentially what you did in chapter 10, except they didn't really talk about the concept of standard cost. So let's look at an illustration. This is exercise S11-1 on how to get the standard direct material cost. Again, we're going to be calculating a standard cost. So in this particular problem, they give us that this company makes a creamy milk chocolate fudge. It says that they sell its fudge to local retailers. It says a unit of a 10-pound batch. That's what they sell. It says the standard quantity of ingredients are, and here's what it is for a batch, includes 7 cups of sugar, 23 ounces of chocolate chips, 16 ounces of butter, 18 ounces of evaporated milk. The standard cost for each of these ingredients are, so they give you the standards, and then they want you to get the standard direct material cost per batch. So the way you'd calculate this is you take these standard quantities, that's basically what goes into each product. You're going to multiply those by the standard price. So I'm going to label this as SQ, standard quantity. I'm going to label the price as standard price. Once you've multiplied those individually, you're going to add these together, and the total standard least direct material cost are $9.61 per batch. So the idea is this is the standard cost in terms of what you think it's going to cost you if you produce a batch. Your goal is always going to be trying to get this, to be the actual cost to actually beat that $9.61. That's what your goal is going to be. Okay, so for objective 2, we're going to look at how to compute and evaluate these direct material variances. Okay, so when computing direct material variances, there's actually 2 variances we're going to be looking at. One of the variances is called a price variance, and the other variance is going to be called a quantity variance. Now, we're going to look at a couple of different scenarios. One scenario is going to be, for example, when the amount that you purchased is going to be the same amount as what you use. So in other words, there is no inventory left over. So we'll look at that scenario, and then we'll also look at another scenario when what you purchased is going to be different than what you've actually used. Okay, so as you're getting ready to calculate your price variance, you can see here in this chart, you've got number 1, the price variance here, and then here's number 2, the quantity variance. And down below, you can see the references of what these symbols mean. AQ represents actual quantity, AP represents actual price, SQA represents standard quantity allowed per actual output, so that's your actual production number it's based on, and then SP represents some sort of standard price. So I'm going to make a note here. When you're looking at the price variance, you're basically looking at how well did you purchase the material. So that one is based on purchases. The quantity variance is going to be based on usage or efficiencies. So when you see this basic calculation, what you're really trying to get to is the actual quantity is what you actually purchased. And what you're basically doing is you're comparing what you paid, that's AP, what you actually paid for the materials, versus the standard price that you paid. Again, you want the actual price to be less than the standard price. You take the difference, multiply by what you actually purchased. That's going to be your price variance. When you look at the quantity variance, it's the same idea, except now what happens is you hold the standard price constant and you're going to compare what you actually used to what that standard quantity says you should have used. So remember, this SQA referencing down here, what you'll need is at some point in time they're going to give you actual production. So you're going to be using some sort of actual number, actual production number, and you're going to be basing the standard input multiplied by that to get this SQA. You take the difference there, multiply by the standard price. That's going to tell you how efficient you were in using your raw materials. So again, like I said earlier, again, your material variances are your price variance and your quantity variance. And then I should have mentioned this on the previous slide, but you can go back and reference it, is that the total material variances is when you combine these two. So if you've got two favorables, you're going to add. If you've got two unfavorables, you're going to add. But anytime you get a favorable and an unfavorable, you're going to take the difference, and whichever one is greater, the overall is going to be whichever one is greatest. So again, what the price variance does is it looks how well you bought your materials. You're comparing, again, what you actually bought, that's your actual quantity, and you're going to multiply that by the differences in what you paid for it versus what the standard says you thought you should have paid for it. And again, your goal is to try to be less than the standard price. And again, the quantity variance is all based on efficiency. And again, what you're really comparing is what you actually use. There's your actual consumption versus some sort of standard consumption based on actual output. You take the difference, multiply by the standard price. That's going to be your quantity variance. And so don't let it confuse you when they talk about what happens if the amount that you purchase differs from the amount that you use for your direct materials. Guys, really, the formula is the same. Okay, your price variance, again, which is based on what you purchased, that's essentially the same. And your quantity variance, which is based on usage, is essentially the same. But just remember, just look for what you actually used every time. Compare that to the standard usage multiplied by the standard price. It's essentially the same formula. Okay, so an illustration of your price and quantity variance. In this particular case, they're making some planters. So I'm going to skip right down here to the problem where they give you the standard quantity used for each planter is 24 pounds. The standard cost is $2 per pound. It says that they produced 3,125 planters, and then they told you how much they purchased and the cost of what they purchased. So the way I typically set mine up is they want the price and the quantity variance. So I like to write out my letters like this. I got AQ, which represents your actual price. You have another AQ here, which is going to represent our usage, and then of course we're going to have our standard quantity. And then you'll notice when I write all this stuff out, I'm going to fill in the numbers here and show you what I'm trying to calculate. And this really works for every problem. So what I do here is for the price variance, again, what I want here is I want actual quantity purchased, which is 78,125. I'm going to write that right up here. The actual price, they gave you the total price. So what you want to do is you want to take that 150,000 and divide by 78,125. That's going to give you a price per unit of $1.92. That's your actual price, which I'm going to write right there. The standard price they told you is $2. So the basic calculation, you're going to take the difference between these prices. So the difference is 8 cents. You're going to multiply that by what you actually purchased, and that's going to give you a variance, in this case, of $62.50. And of course, since you paid less than standard, that's what you want, you're going to say favorable. Now, for the quantity variance, because this is based on what you used, it said they used 78,125. Okay, the standard price is still $2. What you need to calculate is the standard quantity. Well, the standard quantity is what you produced, which in this case was 3,125 planters, and you're going to multiply that by 24. That's that standard quantity. That's going to give you right at 75,000. So that's SQ, or they call it SQA, is what you have to calculate for your standard quantity. You simply take your standard price, you take the difference. So in this case, the difference between what you used and the standard quantity, again, is 31.25. You multiply that out, you get 62.50. This one you're going to say unfavorable because you actually used more than the standard, so you're going to say unfavorable. And then overall, it's a 0 variance overall because one was favorable, the other one was unfavorable by the exact same amount. On the next slide, they'll show you a slightly different presentation of these numbers, but they're going to get the same answer. So as you can look, I basically did the same calculations, but if you look again at your standard quantity variance, here's your standard price. I showed you essentially how to calculate this 75,000. Remember, that's what you produced, multiplied by it was 24 pounds. They got that number. They gave you this. The difference is 3125 multiplied by the standard price. Notice here's your quantity variance. And then on your price variance, again, this is what you purchased. The difference between what you paid, they always state these in per unit. The difference is 8 cents. That's favorable because you beat the standard. So that's why this one is going to be 62.50 favorable. Okay, so for objective 3, we're going to look at the direct labor variances. Okay, so your direct labor variances are comprised of what they call a rate variance. This is similar to your materials when they talk about the price variance, but for labor they call it rate. And then the other one they call is an efficiency variance. Again, this is very similar to the quantity variance for direct materials. So note, when you're calculating your rate variance, the basic idea is you want to beat that standard. So if you look at this calculation right here, the actual rate is what you're paying. The standard rate is what you've been benchmarked. You're trying to beat that. The AH is the actual hours worked. You multiply that by the differences. That's going to be what they call your rate variance. When you do your efficiency variance, again, very similar to the material quantity variance. Again, you compare actual hours versus some sort of standard hours based on a benchmark on actual production. Notice you hold the standard rate constant. Once you multiply these, that's going to give you your efficiency variance. And I've already talked about these, but again, you can review this slide. This basically gives you all the different calculations again and the formulas for both the direct material variances and the direct labor variances. All right, so let's do an illustration on your direct labor. This is S11-5. They've given you the standard wage rate for oil change technicians is $20 per hour. That's your standard. It says by analyzing past records of time spent on oil changes, the Casta Oil has developed a standard of 21 minutes or 0.35 hours per oil change. That's the number we're going to use, is the 0.35. It says in July, 800 oil changes were performed. That's basically your production. It says oil change technicians worked a total of 260 direct labor hours. That's the actual hours worked, and this is the average rate that was paid. So again, we're going to do the rate variance and the efficiency variance. I tend to set these up very similar to the material variances. I write actual quantity. That's the actual quantity. They call it AH. And again, I'm going to set this up exactly like I did the materials just to kind of show you that it's very similar. So let me write these in. So for actual hours, it's 260. That goes where my AQ is. That's 260. The actual wage rate is given at $23 per hour. The standard wage rate they gave you up here is $20. So I can stop right there. If you compare them, the actual rate was 23. That's more than the standard rate. That's $3 more. So your variance for your rate is simply going to be 3 multiplied by 260. That's going to be, again, your rate variance. When we get to the efficiency variance, what we're going to have here is, again, you still have the same actual quantity. $20 is held constant. The standard quantity, to calculate that, what you'll do is you'll take those 800 oil changes, that's the actual number, and you're going to multiply that by 0.35 because you want to compare apples to apples. That'll give you your standard quantity of hours. You'll compare that with the 260 multiplied by 20. That'll give you the efficiency variance. On the next slide, we'll walk you through the exact numbers. So again, you'll note with the rate variance, again, here was your actual labor hours given. The differences between what you actually paid and the standard, you're off by $3. That's bad. So 3 times 260 is 780. Notice you say unfavorable because you paid more than the standard. On the efficiency variance, again, here's your standard wage rate, actual hours. Remember, this 280, that's when you took your actual production and multiplied by that standard quantity. You got 280. This time you beat the standard by 20 hours. 20 times 20 is 400, so that's why you'll say favorable. Okay, so for objective 4, we'll talk about some of the advantages and disadvantages of using standard costing and variances. So now I mentioned earlier, standard costing can be a good thing, specifically if you set good benchmarks, you're trying to attain those benchmarks. It can help you in planning and identifying different areas that can be more efficient to save money. You can provide some sort of reward scheme. It might help motivate people to work harder, and it does simplify accounting. But however, you'll get to the next things that are not so good. You got to make sure that you set the standards correctly. If you set standards that are unrealistic, it can have actually a bad effect, a reverse effect, where people basically don't even look at them. So, but this can be a good thing. Again, anytime you set a plan, a benchmark to try to achieve production, typically if it's done the right way, you can actually have good success and good results with it. And again, I mentioned some of this earlier, some disadvantages. The big thing is making sure that those standards are up to date, which means you have to constantly, be aware of your environment and what's happening in the facility if you're talking about production, so that your standards are accurate. And all this kind of falls into that basic idea. You should have, your employees should have good input into helping to develop these. But again, if you have standards that are not set up correctly, this down thing, you have unintended behavioral consequences. That's specifically when you have either bad standards or they're not implemented the correct way. And you don't want to typically use it as a punishment either. So sometimes you could get some lack of motivation just because if employees see these standards as a bad judgment and you're going to outsource it, or they're going to possibly lose their jobs, that could be another motivational thing that could actually have a bad effect within the morale of the company. Okay, so on the next objective, we're going to look at the overhead variances. So for overhead variances, we'll start with variable overhead. You typically have two parts. This is very similar to direct labor. You're going to have a rate variance and an efficiency variance. So this kind of gives you an alternate name. Sometimes that rate variance is also called a spending variance. So the basic formula, if you go back and compare this to your direct labor variances and rate variances, it's essentially the same. Some sort of actual hours. This is assuming it's based on labor hours. You're going to take that, the differences between what you're paying and the standard variable rate, the differences is going to be your rate variance. And again, the efficiency variance, very, very similar to your direct labor. Again, what you do, you look at the actual hours or what's taking place, take the difference between that and the standard hours based on an actual input, holding that standard rate constant. The difference is going to be your efficiency variance. So let's look at exercise S711 to do both of these variances. So we have Simmons Industries produced 3,000 tables. So here's your production. They go ahead and give you the standard variable overhead rate to be $18. In this case, it's per machine hour. It's not labor hours, it's machine hours. It says each table requires 0.5 machine hours. Actual hours used for 1,550, and the actual variable overhead rate last month was $17. So again, when you do your rate variance, it's very similar. I go ahead and write out my same setup like I do. All these really work for all of them. So I just use the same letters when I do mine. So, but basically what you would put on here, let me finish this. So for your actual quantity, it's going to be your actual hours. So you have 1,550. So notice I go ahead and just kind of plug that in right there. And then it says that the actual rate was $17. That's kind of like your actual price. The standard rate was given at 18. So for my rate variance, you just simply compare what you paid versus the standard. Notice the difference here is $1. $1 times 1550 is going to give you a rate variance of 1550. You'd say favorable because what you actually paid is less than the standard. When you get to the efficiency variance, again, you use the same quantity. The standard price stays the same, and then the standard quantity here, you take what you actually produced, which is 3,000, and you're going to multiply that by 0.5. That's your standard input. That's going to be 1,500. That's your standard quantity there. You take the difference. Notice that's going to be a difference of 50. 50 multiplied by 18. In this case, the actual quantity was more than the standard quantity, so that's going to give you an unfavorable efficiency variance. We'll give you the exact numbers in the next slide. So again, note I just walked you through these. Again, here's your rate variance. And again, here's that difference in what you paid versus the standard. There's that dollar times the actual hours. So you get a favorable rate variance. On efficiency, again, you held the standard rate constant. And then, of course, here you've got the actual hours. Here's your SQ that I calculated. I showed you this in the previous slide. The difference there is 50 times 18. That gives you a $900 unfavorable efficiency variance. Okay, objective 6 is to look at, compute, and evaluate fixed overhead variances. Okay, so for your fixed overhead variance, you basically have two things to look at. You've got what they call a budget variance and a volume variance. So when you're looking at your budget variance, again, sometimes they call this a spending variance. What it does is it measures the difference between actual fixed overhead incurred and budgeted fixed overhead. It's pretty simple. You just compare the actual fixed overhead to the budgeted fixed overhead, and the difference is going to be your variance. If you look down here, here's your basic formula. Notice, again, all you do is take the actual, subtract the budget, the difference. And of course, you want the actual to be less than the budget. And then we'll walk you through a couple examples. The volume variance is a little bit more tricky. The basic formula for this one, again, you take that same, you got the budgeted fixed overhead, you compare that to this standard overhead cost allocated to production. That'll be the trick to get that. The difference there is going to give you your volume variance. So essentially what you're looking at with these fixed volume variances is your utilization of your fixed capacity cost. That's essentially what you're doing. And so again, we're going to walk you through some illustrations on how to get the calculations. So we're going to look at exercise S11-8. This is where a company makes premium doghouses. It says each doghouse requires 1 hour of machine hour for its elaborate trim and finishing. It says for the current year, it says they calculated its predetermined fixed overhead rate to be $21. The company budgets fixed overhead to be, their budgeted fixed overhead is $14,000 per month. Lastly, it says they produced 1,000 doghouses and they incurred $17,000 of actual fixed overhead. So notice right away, we've got our budgeted fixed overhead here of $14,000. We've got actual fixed overhead of $17,000. You could take the difference right there, and that, of course, is going to give you your budget variance. But then I'll show you in a moment how you're going to get that volume variance and what the calculations you're going to use on that one. So you'll note on your budget variance, this is the easiest one. You just compare actual to the budget. So in this case, it's a $3,000 unfavorable because you spent more. On the volume variance, notice you compare that same budgeted number. They gave you this number, this 1,000, what they're going to produce in the problem. They gave you this fixed overhead rate allocation number. What you're going to do is you're going to multiply this by that 1,000. That's going to be your allocation number. That's 21,000. You compare the budgeted fixed to that number. The difference gives you a 7,000 fixed volume variance, favorable.